Hi, and welcome to Decoding with Finsec, another episode. And this time, of course, we have Amit Tandon. I think everybody in corporate India knows him. He's also India's most diversified shareholder, if I can say so. You still have one share of every
We
company?
still have a share in about 1,200
1,200
plus
companies. Okay.
companies. Yeah.
So, very brief introduction to those few people who don't know him. He runs India's leading proxy advisory firm. So he kind of advises investors on how to vote in shareholder meetings. And of course, they have standards which are significantly higher and stricter than what is prescribed by the law. Which of course also means they're contested often, at least in the media, saying that we don't agree with those norms, etc. I think broadly, it's been I would say it's been a great force for good, the advent of proxy advisors in India. I think this people have kind of realized that this uh, living by the lowest standards is not good enough. So I think it's been a good force for good for corporate India. Um
Thank you.
more importantly, I think it's you also have an important voice in terms of how companies govern themselves. So today, I think we're going to talk of two kind of broad themes, and again, I'd like you to maybe just wear a slightly different hat and tell us from a little jurisprudential perspective, whether we have gone overboard in terms of over regulation. Have some of the laws, in fact, exceeded even your standards today. So the two broad themes I would like to discuss with you today. One would be related party transactions, and of course, the industry has certainly been kind of having issues with what is required to be disclosed and to put under the shareholder vote. So maybe I'll just ask you to give you a kind of overview of related party transaction that is as it has evolved. Number one, and secondly, your kind of critical perspective of
Sure.
where we are today
Sure.
and where we need to be.
Sure. But first, thanks a lot for inviting me. I have been hearing a couple of these. I won't say all, but I've heard a few of them, and I'm delighted that you've invited me to speak on one of these. Um, yeah, there is, of course, this whole thing in terms of disclosures, and it begins right from what is there in the offering circular or the draft red herring prospectus to increasingly what is being presented to shareholders to vote. And when we kind of step back and look at what has happened, clearly it's the related party transactions, which seems to have agitated SEBI a fair degree. And therefore, if I were to kind of look at the various regulations and the their conversations, what they're asking companies to kind of disclose, I think it will be fair to say that related party transactions have taken uh, a disproportionate amount of airtime as far as regulations is concerned. The As far as the regulations is concerned, it was kind of I guess at one level these were all just seen as ordinary resolutions, and then sometimes before the Companies Act and came, there was this proposal that look, can these become majority of minority resolutions? And over a period of time, this conversation gathered some degree of momentum, and it was the Companies Act which said that okay, these are the transactions which will require a majority of minority approval. In other words, if I'm a related party and I am the beneficiary, so to speak, of a particular transaction, then I don't get to vote on it. It's the other shareholders who get to vote on it, and they decide whether the transaction will go through or not. Of course, it is got some perverse consequences of a few shareholders who have strong views can maybe uh, decide the fate of the company. But having said so, those instances, when we look back, we've not seen, at least I don't recall seeing any instance of green mailing or something what we believe is should you know has been defeated just for the sake of having defeated a resolution. I think I think RPT is in the news a little bit because the industry standard forum has recently come up with a set of regulations, and they would uh, they seem to have kind of taken the whole market by surprise. It certainly seems to have taken corporates by surprise, despite the fact that it was the industry standard forum which was there. So I think if I were to kind of hazard a guess, I guess it was there because the, there's always a trade-off between what is it that the regulators want and what is it that is from a perspective of investor protection, and the other is from the ease of doing business. And my sense is that it was hoped that, look, if you have the industry standard forum, there will be some balance between these two. But the surprise was, I say surprise, primarily because it kind of tilted very much in favor of what is it that the from investor protection focus rather than ease of doing business. That's the surprising bit. Is it good? Is it bad? We haven't had actually enough of a runway to look at what has happened. It was to be rolled out, if I'm not mistaken, 1st June or 1st July, and now they've decided to hold it in abeyance. So there were companies which kind of tried to beat the market, so to speak, and come up with resolutions before the season. So you did see some of them come up with resolutions before the season or the AGM season hit us, and rather than wait for the AGM. But now that it's been kept in abeyance, we'll have to wait and watch and see what is going to happen. I think my sense is sure. What it's doing is that there is a lot of visibility, but there's very little vision which gets which comes out when you look at some of these resolutions. Uh, it is also, I kind of step back and say that, look, from an investor perspective, how do investors view RPTs? And you find that it's not even the top three voted against resolutions, which are ESOPs, compensation, and changes to the charter documents where specific rights are given to a
So you're
set of
saying investors
shareholders.
are really don't care that much.
So I'll kind of again break it up into two parts. So a lot of the resolutions which come are routine. So we've just had the AGM of State Bank of India. For the first time, we've seen them bring related party transactions. I think there were 16 or 17 resolutions, if I'm not mistaken. Half of them were transactions with regional rural banks, and some of them were transactions with, SBI cards, SBI Life, SBI General. So, therefore, to that extent, uh, it's not a concern for the investors. Okay, so let's leave aside the fact that you can turn around and say that this is State Bank of India. It's not going to happen. But even when you kind of look at the private corporate sector, you have to break up transactions into two. Those which are in the routine in the nature, and an example is, and I'm making it up
Yeah,
as I go
yeah,
along,
of
but
course.
Hindustan Unilever, they manufacture Dove soap in India, Sunsilk in Malaysia. So therefore, Malaysia buys Dove from India, and India buys Sunsilk from Malaysia. There's really nothing which will kind of get investors to worry about a transaction like that. Where you worry about is the fact that there are some adjacencies. And by adjacencies, I mean that, look, there is, or dependencies is a better word, that you've got some promoter entities which are supplying a critical raw material or a part of a infrastructure utility, and you're kind of using that. And therefore, if is the pricing fair, not fair, even a small, 0.5%, 1% will in aggregate in absolute amounts to a lot. The second is we have to recognize that we're living in an era where there are a lot of boardroom and family skirmishes. So it's okay if you've got, let's say, the father who owns both the operating asset and the utility, But as it kind of moves from the father to the sons and the sons to the cousins, what happens to those assets will should there should the brothers or the cousins not or brothers or sisters or the cousins not see eye to eye. So you're worried about some of these dependencies which are created, and therefore you want to know what is happening. So the good thing is that we weren't aware of some of these transactions, so there is some degree of transparency which has come in, but has it kind of moved the needle for a lot of investors? Unfortunately, or fortunately, whichever way whichever way you're looking at it, it's not kind of made a material difference to what is happening as of now.
Now, that's very interesting because uh, gives a whole new perspective to how RPTs are treated. Like you said, I think it's much more kind of current with SEBI than with investors, and also SEBI has taken such a huge departure from the Companies Act, which basically focuses on disclosures. And I don't think that requires any kind of shareholder approval if it's at arm's length and fair price. So this entire thing has been created solely by SEBI and not by corporate law, that you have to go to shareholder. And I think there is some level of perversity which creeps in, because you have a 60% shareholder who cannot vote, and it's basically the rest is those present and
Yeah,
voting, which can
yeah,
very often it's 5% of the entire shareholder base of the company, and out
yeah.
of which you take majority or special
Sure,
majority. It's
sure.
really 2% of the people who really have no skin in
Yeah,
the game, who
yeah,
end up kind
yeah,
of
yeah,
taking a call just based on their hunch, really, and
yeah,
then probably
yeah,
hopefully
yeah.
at least some input from proxy advisors. But broadly, it's kind of more of a roll of dice rather than what is fair
Yeah,
or what
yeah,
is
yeah.
not fair.
Except I'll just say that look, if you look, we look at we track the data on voting quite closely, so the number is much higher. It's now in the 70s and not the. So even if you kind of leave out the promoters, you've got the institutional shareholders who, not in terms of percentage of ownership, but in terms of number of shares, own about 30 27 28%, but let's, for the ease of calculations, let's say 30%, and they're voting about 85 87% of the shares. So that in itself gives you 20
Okay.
25% of these shareholders are voting. So that number
Okay.
is rarely
Yeah.
5%,
Yeah.
though of course there
Yeah.
can be those smaller companies which
Yep.
are
Yep.
not so well tracked, and part of the 1250 companies which we track, where you've got
Yeah. Yeah.
a few number of
Yeah. Yeah.
shareholders. But yeah, and it can be worrying in
Yeah.
those circumstances. Though I will say that we've not come across any instances, but which doesn't mean that it will not happen.
Yeah. I just remember a case, I think some Tata company where 3% defeated a resolution. This is
That's
many
right.
years back, if
That's
I
right.
remember right.
That was,
So,
I think it was
I mean,
Tata Motors on
yeah,
the compensation.
yeah, yeah.
That's
So,
right.
so the I think the point really is, I think RPTs, yes, I think the kind of cases in which you have some unlisted company
Yeah,
run by the promoters, those
yeah.
kind of cases, I think it's a fair game. But I think it's capturing a lot of other stuff today.
It's capturing a lot of other stuff. So, Sandeep, I think what's happening is that I think there are two consequences. One is it's capturing information. Not all of it is relevant. You can, as you pointed out, in where promoter controlled companies, that look, 100% of it is going to one of the promoter
Yeah.
controlled entity, or 75% or 80%. That's one aspect which is important. But the other is that, the sheer number of
Yeah.
resolutions. So, so far we've seen that the highest till last year was 33.
Uh,
But now, if people kind of decide that, okay, each transaction, so if you've bought, uh, shoes, it's one transaction, you bought soap, it's another transaction, and you've bought, electronic clocks, that's the third transaction. So that kind of goes, that number increases. And therefore, in some of that data, the fear is that, companies can slip in something
yeah.
which you kind of miss out. So you're kind of losing track in terms of what is material and what is critical. So, as I said, there is visibility, but there's no vision.
I think that's a good perspective, because I don't think people realize, a, the gap between corporate law and securities law with respect to RPTs. And second, the gap between SEBI
uh,
and investor
yeah.
interest, which is an interesting
So,
perspective, which I learned
uh,
actually
uh,
for the first time today with you.
right.
I didn't know
But the
this.
other is that, it's a little bit like, I will say, it's unfortunate, but the direction we are heading in now
Mm,
is that of, the offered circular.
mm,
It's got, 54 pages of disclaimers and saying risks. And they're all kind of risks, and investors kind of just open it from the 55th page
yeah,
and ignore those first
yeah,
54. So you've kind of got all the risks, the litigations, and everything which are disclosed there, and after that you move on. But you're a lawyer. Is this what SEBI is proposing? Does it stand, will it stand scrutiny of the court if you turn around and say this has happened, or is it a part of, because it's a part of the LODR, it can fly?
it can fly, and I think, frankly, nobody challenges these regulations. It's very rare that they get challenged, and usually the courts are much more lenient. They say, okay, we have an expert regulator, we're going to kind of defer to their expert knowledge, and we're not going to replace our kind of sense of what the law ought to be with. So that's usually the kind of the very limited remit of a writ court. Unfortunately, since last several years, because of Supreme Court ruling, SAT, which is also an expert body, which is the appellate tribunal, is no longer allowed to review the
The reg,
validity of
yeah.
uh, regulations,
uh, uh,
which means you have a writ court which has very little either interest, expertise, or even kind of ability to kind of say replace their own wisdom for
yeah,
that of the regulators. So I
uh,
think that's been, um, I mean, that could be a major area of reform to kind of specifically give it to
yeah,
SAT to
uh,
review, because they see this morning to night. They
uh,
understand these
uh, uh,
regulations. So there's completely, if you think of it, there's no review of regulations. Though I mean,
uh,
technically now they go through consultative process and stuff like that. But I think there has to be some level of deregulation which is coming, and I think we're going the exact opposite direction with this ISF business, unfortunately is, I think, just getting into minutiae, and I don't really know the legal validity of these industry standards bodies. Are they regulatory issued? Are they kind of private thing? What happens if you violate them? I mean, it's these are kind of quite amorphous, if I can use that word. Um,
but
so
yeah, as I look, it's, as I said, there's a little bit of swinging in the other direction, but I won't say it's all bad. If I've created, I don't want to give the impression that it's all bad. There are some elements which have been kind of thought through
yeah,
and introduced, and therefore, but you the
yeah,
bits and pieces which we do worry about, but at the end of the day,
mm,
given where we come from, more information
yeah,
uh, brings greater
yeah,
transparency,
yeah,
which has to be
yeah.
overall in the interest of the market.
No, I think fair enough. But I just worry that there's just the kind of, I mean, I'll give you my
Uh,
own example. When people earlier used to call me whether I need to disclose something or not, I could tell them on the phone.
yeah,
Today, there is no way I can tell them anything on the phone.
uh, uh,
I tell them that not only will I get back to you by evening, I'll probably tell them wait for at least 2 days before I can give you a cogent answer.
uh,
Just to come to the second topic, the example of, when a resignation of KMP, now that's specified in the ISF.
uh, uh,
So if a person resigns in January with effect from February, it specifies, you don't have to disclose it in January. You can disclose it in actually March, which is 7 days after your end of February. So, every single thing is going to be
uh,
very
uh,
specifically
uh,
monitored. I think the only thing which troubles me is, what is kind of the legal validity of this. So if I disclose in, let's say, a little bit late, or I disclose early in January, is that a violation? If it's a violation, it's a violation of what?
uh,
So I think
uh,
it brings in a lot of certainty, yes. But is it necessary to bring in certainty to when you're going to decide,
uh,
the disclosure point is, uh, basically taking away all the discretion of when something is quantitatively
uh,
material, having very, very, very specific standards, which of course I think in a way, it's good. I mean, I'm not saying that it's
As a
always.
lawyer, you should be happy.
As a
Uh,
lawyer, I should be happy.
as a lawyer, you should be happy.
But
But
I
look,
think it just if you think of it from specificity, I think specificity. In fact, many transactional lawyers are very happy with specificity because you know exactly
yeah,
what to do. That
absolutely.
on 28th of February, I will have to disclose something. Brings a lot of
Uh,
peace.
uh,
But at the end of it, you have you know we just go regulated so much. I think it's difficult to comply, frankly. If you
uh,
look at mutual fund regulations, this is the regulation and master circular exceed 1,000 pages, and still you have
uh,
something known as what the SEBI calls fit and proper, which
uh,
uh, we see so many cases where they've not relied on those 1,000 pages. They've said fit and proper case,
uh,
which is very abstract. So you have kind of 1,000 plus a million pages of law to interpret and kind of
uh,
comply with,
uh,
which is practically humanly impossible for
uh, uh.
anybody to
So look, while we do kind of try and take into account what the regulations are saying, we do again overlay it in terms of, how would investors view it. So the question is, look, one is that, you've kind of been fined because each sack of cement was to be 50 kilos and some of them were 59.5, and therefore, do you make that disclosure? But in the overall scheme of things, is it material? Is it not
yeah,
material? So that becomes very critical. And the other, so we look at it in terms of, look, is it going to have a significant, or not, I won't use the word significant, will it have some bearing on the profitability
yeah,
of the company or the sales of the company? And therefore, is it information which would be useful for
yeah,
investors? That needs to be disclosed. On a couple of other things, our view is that, look, we look at the primary regulator. If your primary regulator is SEBI and you're a mutual fund, your primary regulator is SEBI, SEBI finds you, you need to disclose
yeah,
that. But if someone says that, look, shops and establishment, you've got an office in Karkardoma or outside Delhi, it doesn't have the certificate on the front door, we find you, we are not losing sleep
yeah.
over that. So that's how, or maybe that's the approach to take. That, is it going to have a bearing on the profitability? Because again, I come
Yeah.
back to it that uh, that's what matters to the investors. That's
Yeah.
what they are keen to know. The
No, so absolutely. So I think let's come to the second topic, which is disclosures, and again there's been a sea change in terms of what needs to be disclosed. Again, same principle. 6 months back I could tell people what this has to be disclosed, this
yeah,
doesn't have to be disclosed, and today it's kind of a huge sea of
yeah,
things which have to look at. Whether I gave you the resignation example. Whether regulatory show cause notices have to be disclosed. Again, that's subject to
yeah,
whether it's comes from a regulator or a non-regulator,
yeah,
and then you have to apply the materiality standard. If it's from a non-regulator, you probably don't have to apply the materiality standard. If it's from a regulator, you have to apply a materiality standard. And again, it's very hard to argue against having more disclosure, but
yeah,
sometimes it's kind of just the example you gave, in Karkaduma, whether the signboard, which had to be a particular font according to Shops and Establishment Act, if even if you get a penalty, whether that has to be disclosed, I think we're kind of losing sight. And again, you see that in prospectuses, right? This is kind of the best
yeah,
example where
yeah,
you have hundreds of litigations
yeah,
and you're forced to kind of
yeah,
mention all of
yeah,
them,
yeah,
really,
yeah,
whether it's
yeah,
really
yeah,
because people don't want to take that call also,
yeah,
and
yeah,
partly because we've had all these new rules which talk of um, disclosures even without reference to materiality. I can understand if there's fraud and stuff like that, where if somebody's stolen 1 rupee, you want to disclose it. But I think we've gone far beyond that today in terms of what has to be disclosed, this
yeah,
and the specificity. And people are just frankly kind of burdened with
yeah,
hundreds of pages of information which they don't find relevant at all.
yeah, yeah.
So just kind of you
So
have to
there
pour
is
out.
actually there is, look, once the decision is that you will regulate through disclosures, it becomes very difficult to then draw a line and say that, okay, this is what you need to disclose, this is what you don't need to disclose. You need to have boards exercising some degree of judgment, but as you said, the board is always going to turn, or is mainly going to turn to a lawyer and say, should we not? and
The
they
learner will always say
will
yes.
always,
That
yeah,
is
you
trust.
will always get the answer yes, which means that there is a creep. There is a creep in terms of more and more disclosures, and then
But I mean,
you
the contra perspective is this, that it becomes a piece of garbage at the end of it. Those 550 pages is just, it just discloses so much that, the real important stuff. And I think the classic example in the DRHP is the risk factors. 80% of them are completely, just copy pasted from other DRHPs. They
that's right.
have no meaning. They talk about, you know a war situation in which our
Yeah,
factory would get destroyed and therefore we would not be able to. I mean, those things are known to people. You don't have to say that, if there's a nuclear holocaust, the demand will flatline. No, and again, we SEC takes a different approach. So it's not like this is a standard approach. They want plain English. They want simply put and very, very specific disclosures to be put in the DRHP, and they've aligned it completely with the annual report. So the annual report and the DRHP look identical. In fact, the line items are also identical. So you see that, I think, again, I've been a part of disclosure committee of SEBI very long back. There were, of course, we try to um, make that a lot more rational, but I don't think it's even something as simple as an integrated disclosure, where, if you're already a listed company, your IPO document should not be more than 30-40 pages. Really, it's basically updates from the last annual report plus, the transaction specific details. So do you see anything happening in terms of some rationalization of disclosures? Because, like I said, too much of disclosure means that you're actually hiding things in your footnotes.
yeah. So look, most of the conversations with SEBI is there is a realization, but it's a question of that how do you then after that, you know, dot the I and cross the T. If you have to reduce it, what do you do? So I think there is this whole thing of the expression I use in some other context, but it can apply here is that the regulators are circling to land. They realize they need to make some changes. So you know they try and see that okay, can it be shorter, more succinct, can it be a little bit different? But I guess it's coming on the fact that maybe just the ecosystem, if things go wrong, then they'll turn around and say, what did SEBI do as a and that's while I'm saying SEBI, it's true for all regulators. What did the insurance regulator do? What did the Reserve Bank of India do? What did so and so do? Because this should have been disclosed. So all these, I guess the way to put it is that look, if it's there, no one's reading it. But if I can use the word shit hits the ceiling, then everyone is saying, scrambling around and looking for it and saying, why wasn't this disclosed? So how do you address a challenge like something like that? Either you accept it that look, there will be 10% will get filtered out, some
Yeah,
of it would be critical, unfortunately you lose that, or you say that look, more and more
yeah,
needs to go out. So it's difficult. Now will it come with the maturity of the market? I hope so. As investors get more sophisticated, as other market participants get more sophisticated, uh, there will be a little bit more of spirit and less of the letter.
yeah,
But till then, and look, let's face it, companies, there are a lot of instances that companies want clear guidance.
yeah,
They say we don't want to leave it to chance. And then you have instances where, you know, again, companies do play fast and furious. So I'm at one level, I have a lot of, I'm sympathetic to the way the regulators behave. So just something which, I mean, it's not new, it's from some time ago, but something as straightforward as, having women directors on gender diversity on boards. And people spoke about it, but nothing happened. It was stuck at, 2 to 3%.
yeah,
The regulations came and it jumped from, 4 to 12, and it's now at about 20 or 21%. So because regulations have asked for it, companies have done it. And I will again say that in a lot of instances what we find is that the Indian regulator has been ahead of the curve, and has kind of asked for disclosures, etc., which other markets always say that it would be good if our regulators had asked for it. So either you set a standard that, look, once you've disclosed something in the, let's begin with the red herring, draft red herring. Once you've disclosed it, then it has to be a part of the ongoing disclosure.
And we have a big gap between.
But that is where there is a bit of a gap. But that will, as you say, if it's 550 pages, it's going to be a pain. So maybe the starting point has to be that, relook at bits and pieces there.
And like in Greek plays, you mask was not a means of hiding; it was a means of showing your character. Here it's the other way around. You have 550-page prospectus. It's very easy to hide corpses inside that. So it's.
But it's actually also difficult to figure out what is material, right? I forget that. I mean, you would be reading so many court orders, etc., etc. I mean, there is. I don't know whether I should be saying it and what the consequences are, but a lot of them can be much more succinct and briefer than they are, rather than the history and this is what happened and this is what happened in 1867 and this led to this and this led to this. So
let me just give you one example. For instance, every DRHP, almost every DRHP I've seen talks of risk of earthquake to our factory, right?
Yeah.
Now, that makes sense if your factory is in a seismic zone.
Yeah.
If your factory is in Navi Mumbai, it makes no sense to put it out there. So, I think people have lost that sense of taking that call and removing it.
Which is why they don't read it. Which is why they don't read it, and they begin from
550 pages.
Yeah, and as I said, 54 pages of risks, and you begin reading from the 55th page.
Exactly.
So that's what I fear will be the danger with disclosures on the RPTs, and asking the audit committee to look at them with a threshold of 1 crore is also not. It kind of, again, the audit committee themselves will be so exhausted looking at 550 pages of disclosures that after the 22nd they'll say theek hai. So you can easily bury something page 401 and say we disclosed it to you didn't pick it up. So that exhaustion is what we should be careful about, and therefore it's in that context that if some of the limits need to be revised, then it needs to be done.
Right. So I think we've, I guess, covered a lot of ground in terms of the jurisprudence of both disclosures and RPTs. Any kind of final thoughts that you have in terms of, where do you think we need to go? Of course, we've gone into some detail on that, but if you were to advise, let's say, a committee of SEBI, where do you think are the major sources of reforms in terms of RPTs, disclosures? Just your final closing thoughts.
So just two. So I know you have strong views of majority of my route, and we've discussed related party transactions. But one of the areas where I believe we can introduce, related party transaction is on the compensation of promoters. It's very odd it's very if as a promoter I get to vote on my own salary, it's going to be pretty high. So when we've looked at the data for the last 4-5 years, you consistently find that the increase in salary has been higher than both the increase in top line and the bottom line. And you have to recognize that, look, their wealth is not in the salary, but the wealth is in the shares. But people forget that. So we, for one, do advocate that compensation needs to be brought in as a related party transaction, despite all what my comments have been on related party transactions. So you've kind of
and investors find it very important.
And from investor perspective, it's, if I'm not mistaken, the second most voted against resolution after ESOPs. And ESOPs is again, and again, there's a lot to be said there in terms of clarity. So investors don't have clarity in terms of, let's say there's a variable pay. What will determine the variable pay? Is it top line, bottom line? Is it because you're able to deal with some regulatory challenge? Is it a geographical expansion that you're looking for? So what will determine it, rather than just say that, look, the steel cycle, it's up, so you're going to get paid more, right? So you want those disclosures also. So I'm not saying we should just blindly copy it, but I think about a year and a half, 2 years ago, the SEC asked for the benchmarks in terms of pay versus performance, and what are the benchmarks. Therefore, as an investor, I have clarity, and particularly since I'm paying out large amounts now, I'm paying out 50, 60, 100 crores as compensation, so I need to know. The second is, again, to you know just given the ownership structure, we find that, and just to inundate you with some numbers, the promoters own about now 50%. So it's the number of shares, and they pretty much vote all the. I mean, other than when there's a family dispute, or where because it's a minority of because it's a majority minority, they don't get to vote. They're always vote 100%. And therefore, you can say that all ordinary resolutions in any case will go through. That some of them don't is a different issue. And then you look at the other voting, you'd find that about 67, 68% of the votes by law of large numbers, if you look at it, go through. So there are enough instances where, instances where 100% of the institutional shareholders who voted have voted against. But forget that. So we find that, look, last year there were about 4,500 resolutions. 10% of them got 10% institutional dissent, right? Which is about 450. So we believe that the boards should kind of look at the dissent, or total dissent, not just institutional, and take it into account and say that, look, how is it that they will take into account some of these concerns which shareholders have. At the end of the day, their interests are also aligned with those of the promoter. You
Sorry,
would expect.
so maybe
You could
what
have
you wrote about yesterday. Maybe if you can explain
So
that.
you should have what I've called a shareholder dissent review mechanism. So you look at what is it, engage with the investors and other stakeholders, figure out what their concerns are, and then decide what you want to do. You're free to ignore it. You can say that, look, it really doesn't, they don't have the full picture. This is what our long-term thinking is. But if that's not so, you can say that, okay, we take into account and we will bring about certain changes. You can kind of come back to the shareholders or say, okay, we'll address this concern next year.
So the shareholder vote would have succeeded, but it goes
shareholder,
to the board.
It goes to the board. The board takes it into account and say, okay, we're hearing what you have to say, and we will factor it into account as and when we kind of come back to you, or plan out our business strategy, or wherever it is. But I keep saying
it's an input, but not a decision. Really,
that's right. It's an important input which you should take into account. You look at it this way: the president has the right to return something to Parliament or the cabinet,
and he has to sign it if it comes back.
And he has to sign it if it comes back. So that's what we're saying. That look, you go back, the president sent it back. You will give it some thought, but you can still say, no, this is how this is a promise we've made to the electorate. So this is what we'll go ahead with. So you go ahead with it. So I think it's time for us to introduce something like a shareholder dissent review mechanism.
Those of you who want to read his piece, it came
in Business Standard
yesterday's Business Standard. So
and I'll share a copy with Sandeep. He's free to circulate it.
We'll link it in the podcast below.
Absolutely.
So with that, many thanks, Amit, for coming all the way and taking so much of your time. And
always good to see you, and always good to come to your office and meet your team.
Thank you
They're
so much.
pretty energetic.
Thanks so much.
Thanks a lot. Bye bye.